Good evening, ladies and gentlemen. In our flagship show, Market Masters, we get you to meet the finest brains on Dalal Street and this time Wall Street. People who've navigated the bull and bear markets over decades and created immense wealth for their unit holders, for their near and dear ones, and have the same ability to put that quality to work in the coming decades or so. Quite a delight to welcome Mr. Ajit Dayal. He's the founder of Quantum Advisors, which is the sponsor of the Indian Quantum AMC, which manages about 3,500 crores on domestic Dalal Street. And overall, Mr. Dayal advises upon $2.5 billion in international assets. He's a very, very well-known investor on Dalal Street, and I've had the pleasure of knowing him for the last 3 decades or so. He joins us from Miami and is therefore the right person to ask about all the world which is facing the trouble from Mr. Trump. Very good evening to you, sir, and a very warm welcome. We'll start with this tariff issue that the US has put forth in front of the world. It's already put it on EU. Japan is angry. Mexico and Canada are also pissed off, and there is an equal chance that India might also be in the same basket as other countries. How do you see this situation globally with so much of tariffs put in by America on the rest of the world?
Well, since April 2nd, when you've had the Trump tariffs and what we call the Great Reset internally, I'm actually in Miami, not too far from where President Trump has his wonderful retreat. Sadly, I'm not invited to the retreats. But I can say this is that clearly what we have seen since April 2nd is a complete reset of how the world thinks about trade and of how the world will think about investments also. On the trade side, there's very little anyone can predict. No one has an idea of what the next tweet, what the next post is going to be like, and what the impact of that will be on trade policy. But what one can say is that given the uncertainty that is emanating from the United States, there will be a relook at how one should be allocating assets globally. The one thing investors hate is uncertainty. That's what they hate. They detest uncertainty. When we last spoke in October 2023, interest rates had just started to increase, and people were unsure of where interest rates were likely to be. And we now know that interest rates are going to remain high. So investors have adjusted to the certainty of higher interest rates. And in between 2022 and the last year, 2024, they were unsure where rates were going to be, and they hated uncertainty. So it's not that markets cannot readjust to a fact. Markets do readjust to facts. But what they hate is uncertainty. Whether Mr. Powell, who's now on screen, will remain as a Fed chair, what will happen to, sort of trade policy, they hate that sort of uncertainty. So we are living in uncertainty, and investors are going to react to allocations based on uncertainty, in our opinion.
Okay. Mr. Dayal, in all this uncertainty that you very rightly point out, there are two things which are clear. Investors have expectations, and advisors and fund managers and equity strategists such as you have to deploy money, whether we like it or not. The fact remains that nobody pays an advisor to be in cash. Now, against this backdrop, how do you allocate money to assets? In the same time frame that you mentioned, gold has gone up by about 50-55%. Silver has doubled, at least in India. So, are smart investors getting defensive?
So I'll correct a few things that you said. At least in the quantum world, we do many times advise people on the international side, our international clients, not only that we will keep cash in our portfolio because of uncertainty, but we actually suggest, very unusual for a fund manager, to take money off the table. if we find we have something called an upside potential indicator for our flagship value fund. And in that, we can estimate, and we've got 231 months, nearly 20 years of track record of estimating the NAV of our fund likely to be 2 years in the future. All right. And of course, it comes with all the caveats and everything else that you can talk about in a disclosure. And using that as a profit guide, if you will, of what how much money you can make by being invested with us, we actually guide allocations into equity markets, if you will. So I'd like to clarify that we do get paid for holding cash, because when we hold cash in extremely uncertain times, you're potentially preserving capital. And of course, you take advantage of it when you can, like a time of COVID or time of Lehman going back years ago. But in terms of the allocation, at Quantum Mutual Fund, we built something called 12-20-80, Bara Bis Assi. And the Bara Bis Assi was really an outcome of our experience over the years, individuals, and it came into full force after Lehman and certainly after COVID, where we felt that every investor must have something in cash, what some people commonly refer to as emergency funds. And we call that 12 months of your expenses. What if you spend 1 lakh a month, then keep 12 lakhs really safe. And the other balance, if you got a crore, 12 lakhs is safe. The other 88 lakhs, you are actually moving into a 20-80 allocation that's happening out there. And that 20% goes to gold and 80% goes to equity. So we've been recommending gold for many, many, many years.
Okay, wonderful. Then those folks who've put in money in quantum value, as also in your own personal portfolio, have made tons of money thanks to gold. But what of now? How do you see the remaining, 3.5 years that Mr. Trump has in his second term impacting global assets? We will most likely have higher inflation because these tariffs that Mr. Trump has imposed will ultimately lead to higher costs for American consumers as also companies. Do people in America on ground realize this?
I think right now, as in the case of India, when leadership does certain things, the masses who vote for the leadership, the people who vote for the leadership, are happy that something is happening. And they don't quite understand the economic impact of it till much later, right? In the case of India, when we have made certain policy changes, the leadership has been praised for it by the people who voted for it. And then over a longer period of time, people start getting disillusioned that, am I really better off economically than I was before this new change of leadership? So it's not going to happen in a hurry. Of course, in the US, there are term limits and there are time limits on how long leadership can last. In India, we don't have that. And there can also be a course correction, right? Leadership may realize they're making errors. The policy is hurting their vote bank, and they will change. And that happens in India and everywhere in the world, in every democracy. So the good thing is that the market signals back stuff for the leadership to take course correction. So, yes, there will be inflation. Yes, there will be higher interest rates. It's not the first time in economic history in the US that you've had that. But what has changed dramatically in this last 6 months of the new US leadership has been trust. And people are surprised at certain fundamental facts which they assumed were God given truths are being changed, right? So if you look at how the US has reacted to NATO, they were about to sort of abandon NATO. And then the last 1 week, we've seen a dramatic change where President Trump is embracing NATO and happy that they're spending more. So you'll have these changes, you'll have responses that will come to the reactions of the vote bank and reactions of the reality of life. So these are all, in my view, transient. But there is one thing that has failed is governance. The way decisions have been made in the United States, the way decisions are made in company boardrooms, that's what investors don't like. That I spoke about that uncertainty. I spoke about lack of governance. That, and one other thing that we've realized in the world is that although you can have wonderful concrete structures, and you're showing some on the screen right now, you can have wonderful institutional structures. Ultimately, people who are in these structures have to have the spine, have to have the strength to stand up for what these structures represent. That in the corporate world we call governance, and in the government world we call trust and faith. So in the US coin they have "In God We Trust," right? And you have to have trust in the government. And in a corporate world, you have to have trust in boardrooms, you have to have trust in the CEO, and governance at the micro level is suspect, and trust at the government level is suspect. And that's worrying for investors.
Okay. Mr. Dayal, to paraphrase your own comment, in God we trust and everybody else pays tariffs,
Yes.
is what Mr. Trump is wanting to put into practice. Now, what are your peer group in the US talking about this de-dollarization that's happening, and this insistent weakness that we see in the dollar index as also the currency? Is this here to stay? Will the global trade world be very different from what it is now 10 years ahead?
Absolutely. So I think if you look at the dollar, on August 15th, 1971, President Nixon took the US off the gold standard. Until August 15th, 1971, you could walk into a bank and you could exchange $33 for 1 ounce of gold or vice versa. You gave an ounce of gold, you got $33, you gave $33, you got an ounce of gold. That was a given. That's changed. Now look at the price of gold today, $3,380, right? So if you think about that, the United States of America, the US dollar, has lost 99% of its value against gold over the last 54 years. Absorb that. From 1971 till today, the US dollar went from $33 for an ounce of gold to $3,380. 99% of the value of the dollar has disappeared over the last 54 years. But the dollar is still, in that sense, on a global basis, the reserve currency. We all know that the dollar cannot remain a reserve currency forever, but people who truly understand global trade, who truly understand sort of the use of reserve currencies and the trust that goes with the reserve currencies, do not think that the dollar as a reserve currency will die anytime in a hurry. It will die. It may take 10 years, 20 years, 30 years, but it will fade away. But it's not going to die in a hurry. What will change, though, is the rate of exchange of the dollar against the rest of the world, which is a different thing, which again goes to the Great Reset. If I no longer trust policy making in the United States of America, I will invest less in the United States of America, and I will find other destinations in the world to invest. And those other destinations could be the United States, or could be Europe, could be Japan, could be India. Yet again, India has an opportunity to see these flows that are leaving the United States, which is what's causing the dollar weakness for the last few months. The flows that are leaving the United States are heading into other geographies. India, yet again, is probably missing the opportunity to absorb significant amounts of capital, looking for safety and looking for long-term return, again, funded and with the overwhelming, sort of envelope, if you will, of governance. We're yet again missing. We were supposed to be China plus one, when there was talk about manufacturing leaving China and going somewhere else. It didn't come to us. It's gone to Vietnam, it's gone to Cambodia, it's gone to Thailand, it's gone to Indonesia. We're probably China plus four or China plus three. We're not China plus one. So our policy making on the Indian side, in terms of taxation, in terms of governance, in terms of giving a home to long-term capital, is still pretty poor.
Fair point. Uh, that's a that's a point you've raised earlier as well. How about the fact that at this point of time, domestic capital is buttressing and holding up Dalal Street to the extent which was unimaginable even 5-7 years ago. Your fund is a direct beneficiary of this wonderful monthly SIP injection that happens regularly by retail investors. 27,000 crores coming in each month to buy the dip. So, is value completely dead?
No. So two things. One is about the domestic flows. I think Prime Minister Modi should get a huge amount of credit that since he came to power in 2014, he has single-handedly brought confidence back to the Indian retail investors, single-handedly. And make India great again, if you will, strong India, super India, etc. That thematic has, sort of played on the minds of individual investors, as have stock market returns, and they've allocated more capital to stocks than to FDs. And if you look at the turning point from 2008 after the Lehman crisis till 2013, we had net redemptions in the mutual fund industry for 5-6 years. And it changed really in 2014 once he became prime minister, or as his path to prime ministership became clear. And we've had this phenomenal run, as you indicated, where now we are having more flows from domestic investors than we are from international investors. Of course, that again shows the weakness that we cannot get a lot of foreign capital, but the strength is we've got the domestic capital. I think in terms of what a local investor is doing, is finally, after decades, willing to participate in the growth of the Indian economy, either through mutual funds, through insurance ULIP plans, or directly through IPOs and stock market purchases on their own. That's a fantastic win. And I think that this is just a start. If you look at the total assets of a household in India, about 12% is in equity. So the household savings, only 12%, 12 rupees out of 100 rupees is lying in equity. A decade ago, that number was 4 rupees, right? So you've gone from 4 rupees out of 100 to 12 rupees out of 100. And in the Western world, in the developed markets, this number is 30 to 40 rupees out of 100 goes into stock markets. So we've got a long way to go, which is why we're really expecting that the Quantum Mutual Fund we now have new leadership and a new CEO. We're hoping that we'll be able to participate quite dramatically in that upswing of the flows that you spoke about. The SIPs, where Quantum still remains very small, but we hope to be significant. You spoke about value. I like to talk about valuation and values. Values I describe as governance, that you invest in companies that do well, that look after minority shareholders and don't cheat them. Governance in India is very, very, very questionable. Very questionable. It hasn't improved. It's become worse over the last few decades that I've been tracking the Indian market. We've had more companies list. We've seen the scandals in those companies. We've had large established companies who've done some very strange things. And for all the methodology that SEBI has created of trying to protect the minority shareholders, SEBI has, on the larger scale, failed to do so, in my opinion. But valuations is something which market prices determine. On a long-term basis, we believe that the Indian investor should be able to earn about 11 to 12% rate of return from being invested in the indices. And as a long-term value investor who follows the actively managed approach and doesn't believe in the passive approach to investing, if we indeed are good at our work, if we indeed are smart, we should be giving about 4% every year on basis, better than the index. So we actually aim in the Quantum Long-Term Value Fund, we actually aim to earn a 15% rate of return, and that becomes a hurdle rate for a stock to enter our portfolio. So valuations now are certainly expensive. The index peaked in September 2024, and we had a sharp decline right through April. And then the rebound has brought us just a few percentage points close to our peak of September 2024. So valuations in India are still suspect. And that's also one reason why a lot of foreign capital, which is leaving the United States, is still reluctant to move into Indian public markets or private equity or venture capital because of the valuations.
Okay. Now, before this show started, I made a promise to myself not to get baited by you, but I will. And I'll join you on giving a rebuttal on why probably foreign money is leaving Indian shores. It's a, uh, you know it better than me that the markets are made up of just one transaction. If you buy, then I sell. So if DIIs are so flush with cash, and some of them may not follow the value principle that you have in terms of keeping cash as an asset, they have to deploy. And a smart foreign fund would be one who would sell into momentum, who would sell into a higher valuation and then maybe bide his time to buy the same stock lower, the same sector lower. That somehow doesn't seem to have happened over the last 4 years. Indices have in India made higher highs and higher lows. But to put that analogy across the economy, that we are unable to attract foreign capital, wouldn't that be taking it a bit too far?
No, so I think if you look at the weight of the Indian indices in the global indices, so the MSCI India accounts for a little less than 2% of the global indices. So if you are neutral as an asset allocator and you don't want to bet against the index weights, then your weight in India, out of every $100 you have, you should have roughly $2 in the Indian equity markets, correct? And you're
Yes.
neutral. You're not
Yeah.
taking a bet. The actual weight of India for most international investors on aggregate is less than one, is less than one.
Where
We
would
are
that be?
dramatically underweight in terms of allocations. Why? For two reasons. One is that you have some concerns on governance as a foreigner, and secondly, you have some concerns on allocation because of valuations in the market. So if you look at the flows that have happened in the last 6 months, 6 months is a short time. We're long-term investors, but the 6 month flow gives you a sense. It's gone primarily to Eastern Europe. It's gone primarily to Latin America. It's moving back to China, though hesitantly, because valuations there are nearly half that of the valuations of the Indian market. It's not a question of whether the foreigner is right or the foreigner has been wrong in the last few years. The foreigner has certain metrics which they look at. And the metrics they look at, I've always, and I've been fighting this for decades, so I empathize and agree with you, that they view India expensive. But right now, from a valuation perspective, we can put our hand on the Gita and the Bible and all and tell you that India is not that solidly attractive a market as it was 3 months ago,
Yes.
as it was in December. That's for sure. Are you going to still make money in India? Yes. I'm here in the United States telling people that India, in a dollar basis, can earn them long-term rates of return of roughly 9% per annum in dollar terms going into the future. That's the story we talk about India. 9% per annum in dollar terms is a very good number when the risk-free rate of return in the United States, the 10-year bond, is about 4.5%. The
Okay.
30-year bond is about 5%. So you're giving
Yes.
nearly twice that rate of return, which compensates you for the risk of governance, risk of valuation, risk of being in India, FX rate, everything. So it's a very attractive number. So don't get me wrong. I'm not against what you're saying. I'm telling you the perspective of the foreign investor as they make their allocations. I
Yes. Fair
wish that
point.
they allocate more to us because we would be very happy to make our 2.5 billion into 8 billion, 10 billion
Yeah.
with all the foreign flows.
Yes, I perfectly understand your logic as far as argument is concerned on relative valuations. China, maybe
Correct.
Asia, maybe Europe being cheaper than us, it's fine. Uh, the other thing I wanted to understand from you is, do you see an eventuality where the US 10-year yield will be more than the Indian 10-year yield?
Maybe way in the future when the US is no longer a reserve currency, but not in the very, very near term. I think in the very near term, rates of interest will, of course, if President Donald Trump has his way, they'll be reduced, as it has happened in India. If the leadership in the finance ministry has its way, they would have RBI cut rates even more. So of course, politicians want rates to be cut more. There's no doubt about it. I think the market will keep rates where they are in the long term in India and offshore. But clearly from our perspective, the US yields at this level are sort of right. They're kind of a 10-year number. And if you look at the long-term average is about 4.5%. So the 10-year bond is sort of there. And with all the threats that you spoke about, the tariff, the inflation, the uncertainty of the dollar, rates remaining at these levels seem like a fair analysis from a market perspective, not talking about the politics that may come in
Yeah.
its way.
Yeah. Mr. Dayal, my final question to you is on this massive problem that we face with one quant fund from your part of the geography, which is Jane Street. As a participant of both Indian and US markets, and as a person who's analyzed both sets of rules, whether at SEC or SEBI, do you think Jane Street exploited Indian loopholes, or it was just plain greed, uh, maybe thinking that Indian regulations won't hold them back? Where do you stand on this argument?
So I'll go back to a couple of things. One is that, we launched a family office offering for wealthy individuals in India recently. And in that, the quotation that Subbu and I, my partner Subbu and I have worked together now for 29 years, we said that wealth can be invested carefully or you can gamble incessantly. As the SEBI papers have indicated, the FNO traders in India have gambled incessantly and they've lost what, 1.8 lakh crore as per the SEBI report over 2 years. And Jane Street and others have actually made that money. So in FNO trading, it is a zero-sum game. One person wins, the other person loses. In stock market investing, everyone can win. If you keep on buying stock and the market goes up, it's not that the DIIs make money and the FIs lose money. Both can make money. Jane Street, from what I understand, used the Indian indices that were available and kind of took bets in opposite directions so they could influence the direction of the indices where they were playing, create a sort of a fear on the, if you will, on the banking index that comes down, but you took a bigger bet on the other side and you make money on the broader index, etc., etc. So they used products that were available in the market, approved by SEBI for people to trade in. So did they break a law? No, they were trading products on an exchange approved by SEBI. Should they have disclosed what they were doing? Why should they? I don't disclose what we do. Every month we give a disclosure of what Quantum does. We don't necessarily have to give, but we're a regulated entity looking after retail investors. They're not a regulated entity in that sense where they have to disclose their positions. From my perspective, they've done nothing wrong. Should a Jane Street have been allowed? Should SEBI allow the creation of FNOs and crazy products out there? My answer is no. I'm a very conservative person as the field of finance is concerned. I believe that a lot of this speculative trading is harmful for investors, is harmful for the capital markets. But the regulator has two roles. One is to develop the capital markets, and development of capital markets in this modern age of technology and finance suggests that you have to have derivative tradings and F&O options, and then you are a developed market, a capital market. The other role of SEBI is to protect investors. And as I indicated in the past, and Jane Street is one example, certain actions of the regulator from governance, including focus on F&O trading and trying to get, sort of nice taglines that the NSE or the BSE are the world's third largest, second largest exchange in the world in terms of trading volume. Those are not nice accolades. Those are not nice trophies to have because they can lead in terrible outcomes, as we have seen for F&O retail investors. So I think SEBI should step back and try to figure out when it tries to develop capital markets, does it mean I want to know now go from 50 crore, investors in mutual funds and stocks to 70 crores? Or do I want 50 crore more educated investors to make more educated investment allocations rather than get into speculation? So from a traditional person, from my history, I have a lot of gray hair you can't see at the back of my head. Basically, I believe that bells and whistles and new products like F&O derivatives, I'm against them. I think it's harmful to retail investors, it's harmful to markets.
Would Jane Street have been penalized heavily with a criminal probe if they had done the same thing in Wall Street?
No, I don't think so. Because again, these are products that have been approved by the regulator and are available on the exchange. So unless there was some insider trading, you can't tell someone if you've got products out there to buy and sell and you don't have limits on what people can do. As far as I know, there are no limits. There's no law saying that you can't go short on the Nifty and long on the Nifty bank or index or whatever it's called. If there's a law against that, then yes, it's a criminal thing. Far as I know, there's no law. It's Wild West. And Jane Street is coming to India and playing the Wild West game. And our Indian retail investors suffered in the process. Stock exchanges made the money on commissions, and their valuation in the IPOs will go up, which is good. Jane Street's investors made money, and our investors lost money.
I'm not aware of what SEC laws are against these kind of trading, but there are clear laws within the SEBI Act and the prevention of fraudulent practices where such a practice that Jane Street does is frowned upon. I don't know whether they've walked other side. So
yeah, it's possible. I mean,
Yeah.
I'm not saying that what they're doing is right.
Yeah.
All I'm saying is they've taken products that are approved, that
Yes.
are existing, and they've taken bets on these products. Were there any limits that they had to disclose? If they were and they didn't do it, sure, they've breaking the law. But I don't know if those limits existed or not, if those disclosures existed or not.
Right. Mr. Dayal, as always, it's such a pleasure to speak to you. And I hope we get to meet you soon somewhere when you are back in India around Diwali or so. And
Next
I look
week.
for.
I'm back in India next week, so I'm on my way back home.
Okay. Mumbai?
Okay. Bombay, yeah.
Okay, we'll be meeting. Thank you so much for your time. What an interesting conversation. It traversed Mr. Trump. It went to the gold standard being taken off. It came to Jane Street. And of course, we also had a nice discussion on what value is and how valuations are. Thank you so much. I hope you enjoyed it as much as I did.
I did very much so. Thank you so much, Mr. Bhatnagar. Thank you, Shah. Thank you so much.
That, ladies and gentlemen, was Mr. Ajit Dayal, the founder of Quantum AMC in India and also Quantum Advisors globally. They manage somewhere like 3,500 crore rupees in India via about 12-13 mutual funds, and of course advise upon $2.5 billion globally. Thank you for watching. I hope it was as interesting for you as it was for me.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily Calls, a show that answers all your stock-related queries on the program. In case you're here for the first time, well, the WhatsApp number is